guiding steps in venture's quest. In wisdom we proceed. As markets shift and paths diverge, a vision clear I see. With wisdom's voice, the path we forge, in prudence we're free. Proceed, 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 proceed. With insights deep our course we lead. And when the venture's heart seems torn, in unity we find a beacon bright, emerging dawn in wisdom intertwined. Though paths may part and challenges loom, in collaboration we believe. A shared vision in the room, in wisdom we conceive. Proceed, 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 proceed. In unity our fears recede. Proceed, 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 proceed. In unity our fears recede. Proceed, 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 proceed. With insights through thee, guiding star remains, illuminating paths so bright to clarity we regain. Awakened by the dawn's first light, inspiration's gentle plea guides us through the investment fight. In wisdom let us be, and let us be, let us be, let us be, let us be, let us be. In wisdom's voice, our ventures free.
Day and night tirelessly I strive to settle dues that life demands. Oh, how it stings. Yet when the day's toll is paid, not a dime to my name stands. Such bitter things in dreams of vision so grand. A life of leisure hand in hand, with fortune vast at my command. In joy and jest across the land. Funds, funds, funds would be so lush. In a world of wealth, a rush. Funds, 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 always a gleam. In a world of wealth, a dream. Ah, the splendor I could weave, with just a bit of gold to sleeve. It's a world where wealth sings. It's a world where wealth sings. Finding him is like a maze, but he's ever in my gaze. Oh, how it stings. Should he be free, might he glance my way, or would I just be in a daze? So off I dream to distant shores, where luck and fate might open doors. A twist of fortune, and who knows, my life might just hit new highs and lows. Funds, funds, funds would be so lush. In a world of wealth, a rush. Funds, 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 always a gleam. In a world of wealth, a dream. Ah, the splendor I could weave, with just a bit of gold to sleeve. It's a world where wealth sings.
The shadow of tax grand reset, a quest to raise our fund began. A journey fraught with sweat and toil, yet forward we did run. As markets quaked and trust did wane, a clearer path we sought. With wisdom as our guiding light, a battle fiercely fought. Forge ahead, through the storm we tread. With every pitch our vision spread. When hope seemed dim and hearts grew weary, in unity a flame did spark. A promise of a dawn yet cheery, through endless ventures dark. Though many doors would close in haste, our spirits never sway. Together in our mission faced a foundation we had laid. Forge ahead through rejection's dread. In our cause our souls were fed. Forge ahead through rejection's dread. In our cause our souls were fed. Forge ahead, let no spirit fade. For in our day and night, tirelessly I strive to settle dues that life demands. Oh, how it stings, yet when the day's toll is paid, not a dime to my name's stand. Such bitter things and dreams, a vision so grand, a life of leisure hand in hand, with fortune vast at my command. Enjoy and jest across the land. Funds would be so lush in a world of wealth or rush. Funds, always a gleam in a world of wealth. A dream of the splendor I could weave, with just a bit of gold to sleeve. It's a world where wealth sings. It's a world where wealth sings. Finding in this life the maze, but it's ever in my gaze. Oh, how it stings. Should he be free, might he glance my way, or would I just be in a daze? Such bitter things, so oft I dream to distant shores, where luck and fate might open doors. A twist of fortune, and who knows, my life might just hit new highs and lows. Funds, the lows. Funds would be so lush in a world of wealth and rush.
With their finest tower.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.
Welcome everyone to today's session where we're going to talk about the state of the European VC fundraising market. We are doing so because we have written all through the winter, I was about to say, a report on the current state of the market. And that is, of course, as it pertains to raising VC funds. So if any of you joined in the hopes that you're going to hear us talk about raising startup capital, that's not going to be the main focus of today. It's all about how to raise venture funds. Why did we decide to write a report on exactly this topic? We did so because it's simply the topic that we have seen everyone engaging the most with every single time we have done any content on it. And so we thought there must be some more stuff in Europe that's already doing this, that's laying out their foundation and so on, but we didn't really find it. So we thought it was about time that someone did it. And what we've done is we've dived into the 300 episodes that we've done. We've dived into the latest data in the market, of course, and then we've looked into our dear friend Joe Schorge and Isomer's data as well to see what new insights can we come up with. That has generated or led us to create a report that's quite different from what you normally have. And that's, of course, because us being content creators with a podcast where we've done all those 300 episodes, we did not just sit on qualitative data and quantitative data, but we also sat on a lot of I should call it maybe, hopefully, very exciting interviews and conversations that we could embed into the report. So reading time might not be more than an hour or two, but if you want to watch every single conversation in there that pertains to fundraising, I think we're looking at 24 hours of content almost. So we hope that this will be a bit of a Bible for everyone who is fundraising in the European VC market. So today we're going to focus on the core topics and findings from the report. It's in no way encompassing, but it will at least give you a general understanding of what the report is about, and also hopefully a lot of inspiration, because the panel we've brought with us here today are second to none in the ecosystem. Tom, before we kick it to the rest of the gang to introduce themselves and explain to everyone exactly why I say they are probably the best in the ecosystem, I would ask you to just share a few words about Flow and why you decided to support this magnificent project.
Yeah, thanks, David. Thanks, Andres. So I'm Tom Hughes from Flow. So Flow partnered with the London Stock Exchange Group as a end-to-end private markets platform, specifically aimed at streamlining fundraising and investment activities for VCs. We are fundamental believers in the power of data and technology. So for us, it made perfect sense to partner with the team at EUVC and Isomer to produce this report, because we fundamentally believe that the ecosystem needs information to be shared for all of us to make better decisions. So it was a partnership made in heaven. So I'm very, very happy to support this, and looking forward to hearing and talking and sharing more about this report today.
Beautiful. Thank you, Tom. Now, Daniel, let us hear from you. Who are you? Speedinvest, what's up?
Yeah, thank you. Thank you, Andreas. Welcome, everyone. Daniel Keiper-Knorr, one of the founding partners of Speedinvest, a Vienna-based pan-European seed-stage European tech VC, established back in 2011, now 13, 14 years in, managing a total of 1.2 billion euro in AUM across 4 large fund generations and another 6 funds, smaller ones in between. My personal role over the past 2 to 3 fundraising campaigns, now full-time 100% shifted over to the capital market side of our business, taking care of money supply, if you will, to our firm and to the wider ecosystem, I hope. Taking care of existing LPs, establishing and fostering relationship with potential new ones. So I do this here with a small team of 4 people on my side, in 2 offices over here, headquartered in Vienna, and 2 people in our office in London.
And Daniel, we actually did an episode specifically on your latest fundraise that amounted to 500 million as part of the report. So everyone, if you want to hear more about how Speedinvest managed to pull that off, how they succeeded through the tech reset, let me put it like that, then definitely tune in for the report. You can go to flow.io/raise to already sign up for the waitlist for when it's published now. But otherwise, we'll also send it to you afterwards. Now, Mr. Joe Schorge, would you please tell us a little bit about yourself?
Yes, love to. Hi, I'm Joe. I am the managing partner at Isomer Capital. I love this conversation because we're all about funds, as our starting point to the market. Funds are the way capital gets from, the asset owners to the founders building companies, and this giant channel called funds. So we build funds ourselves, we invest in funds, we help other people build funds. We run 6 funds ourselves right now, 3 of them in our flagship strategy, which is investing 2/3 of their money into other funds, mostly seed funds all over Europe. And we have 3 other things that do slightly different variations on that. And, it's a key discussion we're going to have today, because nothing works unless fundraising works. It is the origin of everything. If you can't convince an investor to give you money, you can't build your company, you can't build your VC firm, we can't build our firm. So it's, I'm glad we're here, and I'll try to contribute in a meaningful way.
That was the terrible truth from Joe Schorge. Now let's go to Katja from Open Ocean.
Yes, hi everyone. So I'm Katja, or Ekaterina Almaskia, my full name. I'm general partner at Open Ocean. We are Finnish-based fund. However, we operate out of Finland and the UK, and I'm responsible for building the UK office. So we are roughly now half and half in Finland and the UK in terms of the team. So we started in 2011 after MySQL was acquired by Sun Microsystems and by Oracle. And then the founders of the company decided to start Open Ocean with the idea that we want to bring this know-how and kind of expertise from building and scaling unicorn business in technology in Europe to more founders. So now we are already in our fourth fund. We just just completed investing from the third fund and starting from very soon from the fourth fund. So, and actually, as far as I'm concerned, I spent most of my career basically in the corporate VC. I started in 2006 investing, and I invested in many countries globally, including in the US and Brazil. But most of this time I spent in corporates, and actually I hit the road fundraising when we partnered with the Open Ocean in 2019, early 2019. And we're raising the third fund. So since then, actually, I am very much involved in fundraising and strategy of the firm. And there were many lessons learned for me personally, but also for us as a firm. I'm also in charge of bringing the strategy of the firm further and evolution of the strategy of the firm. So many interesting topics, and I'm glad also Joe mentioned this, that it's a very important topic, and without fundraising we cannot exist. So I'm glad we have this conversation today.
Beautiful, Katja. And as you everyone to the audience, I say Katja instead of Ekaterina. I've been permitted to do so, so I guess it's okay. Christian, let's get the perspective of a big pension fund guy.
Yeah, first of all, thank you very much. I can only also echo both Joe's and also Irina's comment on how inherently essential it is to, of course, fundraise when you're in VC. On top of that, I also think it's a really interesting topic as of now, of course, because of the last few years that we have had where the sentiment have really changed. But to introduce myself, my name is Christian Petersen. I am a VC-focused investment manager here at IIP Denmark, which stands for Institutional Investment Partners Denmark. And in a nutshell, we are managing the private equity exposure of the Danish healthcare workers' pension funds. So think about it as 350,000 beneficiaries, nurses, medical secretaries, pharmaconomists, physiotherapists, people like that. The doctors have their own fund, so they're excluding there. But beneficiary group is very unique in the sense that they are low to middle income workers. 90% of them are female. They have a quite sizable pool of capital of 60 billion euros. Net inflow of capital from the members. Historically, we have invested in low middle market buyout funds and also co-investments with those managers. But since 2019, we have embarked on this very exciting journey to also invest in venture capital funds. And I've had the huge pleasure to be a part of spearheading that effort. We have been quite active, I would say, in the sense that we have invested 400 million so far into like 40 commitments or 40 funds managed by 20 GPs in round numbers. And around 70% of our commitments are in the States, but also 30% are here in Europe, which is also the center of our talk today. So thank you very much for having me.
Thank you, Christian. So now let me rile the feathers of the gang a little bit and say there's nothing like riding a bull, but neither is there anything quite like getting thrown off of it. And that is something that I believe many VCs had to come to learn for the first time this time around. We've just come off an unprecedented bull run, and it's been extended artificially by COVID stimulus, the ensuing zero interest environment, which of course came as a blessing for many people who wanted to come into venture, and also for established firms to venture either up market or down market, depending on where they were beforehand. The grass was greener on the other pastures, or however that is said in English. And there just simply was enough money to go around, and everything was up and to the right. However, as I just said, this would soon come to a standstill. If we look at this chart where we're seeing the VC fundraising activity over the last 10 years, we can see how we have gone in 2021 from 409 funds raised. And let me look at the number here, 33 billion raised, all the way down to 291 funds raised in 2022 and only 141 raised in 2023. So clearly, something happened here. I'd love to ask our dear panel to comment on what I said, as well as how you experienced going through both the maybe slightly less focus on going through the up market, but let's talk a bit about what it was like to wake up in 2022 to a completely different environment. Who wants to go first? I'll throw Joe into the water.
Thanks. Well, to me, there's nothing new in this. If you look at the same chart for private equity, if you look at it for venture over the last 30 years or private equity over the last 30, 40, what you see is cycles like that. And which is, to me, always a curiosity, because if you read the literature of all the great investors of the last 30, 40 years, they all conclude the same thing, that as an LP, as an investor in general, you should commit to private markets funds consistently over time. That's we all agree that, and academics agree it, and practitioners agree it. However, apparently, few do it. And so you get these moments where, as you described, Andreas, interest rates are low, maybe stock markets are up, investors feel like everything's good, and so they try new ideas, i.e. emerging managers or different markets. They put more money out. And then the reverse is also true. When maybe you've got a problem elsewhere in your portfolio, your public book is down, your bonds aren't performing like you thought, or may have nothing to do with venture, but there's this allocation decision on the high level of a multi-asset investor, and so we just look at it from our point of view in venture and see this ebb and flow. You love me one year and you hate me the next year. In fact, it's a much more complicated equation to do with how investors are allocating capital. And, okay, if this is how it works, maybe as an investor, you can figure out an interesting way to play that cycle. So it doesn't concern me, by the way. I'm pretty sure if we have this talk in 5 years, we'll be, seeing a different swing and having a different, And I think for me, it's remember when things are high, things are never as good as they seem. And remember when things are low, things are not as bad as they seem.
Yeah,
Absolutely true. Absolutely true, Joe. Probably what's also worth keeping in mind is, Andreas, if you bring back up the chart with those bars of the number of funds raised and volume of money collected, these are broken down by years. We all know that raising a fund takes way longer than a year. So that's probably the years when the fundraise has been announced or the fund has been given its official vintage. So take, for example, our fund. Ours is an official vintage 22, but the bulk of the work was done in the years late 20 and 21. So this correlates a bit with the upswing in the market, and now we're on a downward trend. I think and Joe, you're totally right here. What the whole industry has now learned, hopefully, that all markets go in cycles. Ours has been actually the last interest rate cycle was already over in 2019 and 2018 in the US. By mid 2019, we had the Fed rate at 2.75% already. only to get smashed down to zero for COVID recovery measures and all those things. But inflation was already kicking in late 18 throughout 19. Last quarter 18 in the public markets was a very bad one. So the signs have already been there that the cycle is over. It was artificially, through an external black swan event, artificially stretched by another 2 to 3 years, only now to hit hard. And again, in the US, it's government measures, think IRA, to keep the economy booming. So I don't see interest rates coming down. I don't know. I would not know why. At least not in the extent and the speed that many people might hope. And I think that's the important lesson for us techie seed stage venture folks, that we are only a small part in that whole macro game. If the money market returns 2 to 4%, and Christian, you might elaborate on that, and a typical pension fund's target is 6 to 8%, and half of that can be earned in the asset class with the perceived least risk. The appetite for our asset class, where we offer the highest risk, is naturally reduced.
Yeah, and I think that's maybe the levels that you can talk about it, right? Because you can talk about it from an institutional LP point of view or institutional capital base. Okay, where should they invest? And our financial sponsor, PKA, which is consisting of like 4 underlying pension funds, they're very long-term investor, right? So they have like 50% of their total assets are put into alternative space, illiquid real estate infrastructure, buyout mandates, co-investments, and also venture, right? So there you have a considerations whether what you should actually prioritize venture, when it is for many people, unfortunate, actually just a small part of their daily job to actually allocate to asset, right? Or to venture, a class in itself. But I really love what you're mentioning, Joe, is also like, there's nothing new, but there's also a huge difference between what is theory, because what you're presenting here, Daniel, is the daily work of allocators, right? Because from the institutional point of view, it is few people that have the privilege of actually having a dedicated mandate or team that is solely focused on venture. I.e., when you have been hit by, many people have been hit by the denominator effect, and we have too, then you need to focus your time and also the capital that you have available, right? I don't think there's anyone here in the call who would argue that right now is not the right time to invest in venture. It's so attractive because of the valuation reset, less FOMO driven, all those kind of things. Like, we can definitely talk about that for ages, right? And from VC, from the institutional side of it, is much more determined by the denominator effect than a less interest or bullish thought around venture.
I would even take that a step further and say it's always the right time to invest in venture, just as it's never the right time. But if you do invest, do it with a very long-term perspective. That gets back to what Joe said. Don't try to time that market. As soon as you try to time, you're too late, always. And over here, we minted that expression of timing is a tourist trap. It's a terrible tourist trap. Because, it might be part of the human, mentality or human nature to act pro-cyclical. But in venture, this is so wrong.
Fully agree.
And being hit by denominator effect is to a good degree result of having over allocated in boom markets.
Fully agree.
But it's interesting that I was always amazed that actually private markets and especially venture capital are so asymmetric. So basically, people who go into these markets are very attracted to arbitrage opportunities, and actually there is a huge opportunity, but we need to understand that these markets are cyclical and timing is everything. So I joined venture capital myself in 2006. It was just before the global financial crisis, and it was like going up until it went completely down. And I think we have observed several times those situations. What we also observed that actually some of the best companies came out of these crisis situations. So now it's interesting also to see, okay, we taking away that those great companies have been created, venture capital firms exist almost like in a parallel universe. And I think the opportunity is always there, and especially when there is a crisis situation, but we cannot not see the market trends where there is some kind of consolidation going on. And I think I agree with Andreas' chart that actually maybe there are fewer funds that are able to raise, and they are maybe bigger funds, or they try to combine. We have just seen some of those movements, right, with the General Catalyst partnering with La Familia and so on. So it's interesting. So when I look at the situation, I still wish that the market continues and comes back. We all hope and we are all optimistic, because what I think that diversification at the bottom, like having more venture capital firms with diverse backgrounds and diverse views on the market, actually will bring much more fruitful results for everyone in the ecosystem. So I think I really hope that this swing will come back, and we will see again more fundraise, like more funds being able to fundraise, and also new funds coming into the market, as well as established funds continuing this journey.
Can I ask you all, and I'm going to bring up another chart, because there's something about the worldview that can be quite disconnected between a VC, and I would also say, including that bucket, an LP that truly understands VC and spends a lot of their time and thought in venture, versus what you might then either call tourists, or just the ones that are a bit more peripheral to venture and for that reason don't spend all their time there, right? And I'm going to bring up this figure that we have in the report as well, and ask you a bit to comment on the two worldviews that we present here. And this is, of course, showcasing to everyone only listening in right now. I have a figure that shows the VC worldview as it kind of looked like after when the tech reset had just set in, where we had VCs saying the best companies are seeded in a crisis, interest rates have little impact at early stage, more talent available, tech is not a momentum play, it's a long-term trend. All the things you've just said. And then on top of that, we also, of course, had verticalized arguments about inflection points and specific technologies, which, if you were a crypto VC, you would use, or if you were an AI VC, you'd say, well, we're not affected by this because it's actually right now it's booming in our category because of XYZ tech development. But then you have, on the other hand, the LP worldview, where some of them will apply to all LPs, also the very sophisticated, and some might apply more to the ones that care a little less about VC, and for that reason maybe give too much value to each of these arguments. If I list them, one was that the many LPs coming out of or into the tech reset said tech is obviously overvalued. Every company, every deal happened at ludicrous speeds. We did some co-investments ourselves, but in the end, we stepped out of the market because we thought it was just obscene, and we couldn't imagine what these VCs were doing. So there were some that had that experience. Then they, of course, also had said what Daniel and Christian spoke about just before, which is rising interest rates will impact the future earnings and whether you're interested in putting your money in venture. Then you had also the massive layoffs that were happening in the tech companies, which said, well, you guys have not been good stewards of our capital. What the fuck, guys? We've been giving you and entrusting you with our money, and what you build is big castles in the sky. What's going on? So there was a loss of trust as well. And then, of course, we were also seeing the IPO window, which smashed a lot of the late stage market. And I could continue with the LP view here. I'd love to ask you here to comment on some of the things I said here.
Yeah, first of all, maybe to actually link it to our current or our conversation just before, right? When also Daniel said that, yes, that is LPs who have been maybe a bit too bullish on venture or alternative assets in overall. Then you can say here, there's also two sides of the story, that VCs may actually also have been a bit too fast in deploying, and just that you also mentioned earlier, Andreas. And I think that's two-sided, and some of the things that we also talked about, Irina just mentioned finding arbitrary opportunities, but it can also be too late, right? When you then don't catch the wave, because that's so difficult. You should actually already be positioned right now in the AI era. You should actually already have the exposure there you would like and have been warming up this expertise of yours for a long time. And I know, Rena, you have been in that area for the last, like, since 2006 or something like that, if I remember correctly. So I think that is maybe the first story of that. And then afterwards, then you people have had different experiences, and especially if you are here as a newcomer LP, not really set up for the long term, it can be very difficult for people to navigate that, coming from, for instance, buyout, right? 3.5 year or 3 year deployment pace, and now you have venture, 2 years, people coming back. We had that difficulties in our first program ourselves, where we really need to figure out, like, okay, when are people coming back? And we should also prioritize having enough capital to actually back them again, because we don't want to go in and out of funds. We really take it very seriously when we back people, that we also re-up with the next funds if the relationships.
I think jumping on this topic as well, Christian, thank you for also covering this arbitrage. But, you know, I was actually quite impressed or amazed when we were raising our third fund. Actually, I went to the Middle East. It was actually a separate trip, but it happened I met a few LPs there just occasionally, as friends as well, and so on. And I asked them, do you want to invest in Europe? And they said, well, you know, we had really, really bad experience. We invested a lot in 2006, 2007 in Europe, but it didn't bring us a lot of results. And they showed me the lists of venture capital firms they have invested in, which was really interesting. And I didn't recognize most of the names. So these firms have gone, you know, like it was like Pond Ventures and you name it, like you don't even remember those names today. And I understood their point. I mean, they were absolutely correct. But then basically what happened is they have completely missed the wave when UiPath came and all other companies that brought actually a lot of value to a lot of LPs subsequently. So I think there is nothing wrong in having different views. What happens in reality is that actually the world moves forward. I mean, like, yes, we burn our fingers. As investors in venture capital, we also sometimes burn our fingers investing in wrong companies. But the truth is that actually the opportunities continue to exist and the value is being created. And the question is, how do you enter the right opportunity? And this is maybe a longer conversation, how to enter the right opportunity.
Well, I like your point, Katja, and I think it's the difference between kind of big market trends and then individual investor behavior. And that story you described, I've heard that so many times, where, you know, I used to be an investment consultant, and so you'd be called in, you'd be hired to fix a portfolio or rebalance it or whatever, and you'd go in and they'd say, but we don't do that anymore because look how badly it performs. And when you understand what they did, you know, they did market time. So back to Daniel, they did exactly what Daniel advised against, which is they got excited about some asset, dumped a bunch of money, and it stopped, and so had a bad result. You know, but it's very hard for humans to admit their execution was bad. You know, if you're an investment manager in an organization, to say, hey, we got it wrong, you know, that's kind of risk territory, rather than to say, this is a bad market, so we avoid that, you know. So I just think that's outside of most human ability to say, hey, we executed in this asset area very, very badly. And if you apply that to venture's hard. You know, it's a hard business to get right. If it was easy, everyone would do it. And so I think when you compound those factors, even for the best, it's quite hard to get right. And then most big institutions don't execute it well. And I always found, final comment, when I built some greenfield LP programs, started from zero, in year 1 and 2 and 3, it's pretty easy because you've done a study, you have a lot of enthusiasm about investing, and you're meeting new people you can work with, and it's great. The problem comes in year kind of 4, 5, 6, when all this money's gone out, nothing's come back. You probably have a bunch of J curves, and then everyone's sitting around the table going, geez, we put all this money and we got nothing to show for it. What? Oh, we've done a terrible job. And then you have a board change or CEO change, and they stop the program. And you get that, you know, that conclusion that you described, Katja, which is, we shouldn't do this. This is, I hate to say it, this is where Europe and the US are different, because a lot of the US has just been doing it longer. So you have a lot of LPs there that have been doing this for decades, and they can say, well, look, there are times we did well and times we did badly, but on average it works. So we don't like doing badly, but we kind of understand that there will be a cyclical nature to it.
I mean, one thing when having looked at those two columns of quotes from the GP side and the LP side, most of them are just two sides of one and the same story. Massive layoffs on one side equals a lot of talent available on the other side. So it's and this is where this partnership between allocator and manager emerges from. That there is two sides of this story, and that's on one side the privilege to be working on that side of the business, that you get that inevitably that longer term perspective from those LPs that really understood how venture works. So two things are super important to understand, and both might go against human nature. One is that super long-term perspective. Humans always tend to overestimate short-term effects and underestimate long-term effects. Second is power law. Power law is against human nature. Human nature is a bell curve. Everything is average. Average doesn't work in venture. So you can be in top quartile fund and still miles away from the best. But still you are in the best quarter of the market. What is assumed you do well, but this is like in your motorsports. You could be in the fastest car and still miles away from the champion. Like we are now able to monitor every weekend in Formula One.
I'd love to ask you all about how you have kind of managed to straddle the understanding of someone who really gets VC, meaning you, and then talking to an LP that has that mindset that I just described just before, right? Where you guys, venture doesn't work. All these huge companies are blowing up. We have, a long list of mistakes that have been amplified in the media. This perspective, also looking at the stock market and seeing the tech stock taking a hit, especially, of course, in the beginning of the tech reset. How do you, as a manager that knows all the because they're in venture and they understand the dynamics, how do you best kind of straddle that perspective to the other side?
I think what worked for us, and this is specifically when speaking to, say, LPs who are not from the institutional/professional sector of the market, not folks like you, Christian, but that other very important part of the market, which is usually associated with family offices. They come from different backgrounds. They are on a learning curve themselves. I think what is key is to not lecture them in how venture works and it's only our way and no other. It's more like helping them understand venture in their own words and put it in context in their own world. So there is many parallels to be drawn between venture and any other given other asset class. Real estate, for example. Show me the J-curve of a real estate investment. That's the worst J-curve on the planet. It's far worse than ours. It goes vertically down in the first year. You start off with minus 10%, the rub-off costs. But everybody crams into real estate and sees this as the longest term and safest asset class. But if put in perspective, that can be eye-opening to many. Or for example, this one, I very vividly remember that conversation with that one family office we had who had exposure already to private equity and to large, global large brand names, but still had not had the chance yet to get in touch with seed stage venture and as a consequence understand how this works. So I put up a parallel to his timber and forestry investments. It works exactly the same, just 10 times faster.
Yeah, and I think it's a great thing to actually think about what is the context or the background of the LP that you're talking to. I think that's key from any VC. And if they have questions, even if they are questionable or a bit weird, asked for one whose daily work is in venture, I think a fund should be very considerate, or VC should be very considerable around how they actually answer that fully, because otherwise people will not learn by it. And it is a difficult asset class, as Joe also just mentioned, and you also alluded to here, you need to be there for the long term. The feedback loop is so complex and so long, even longer than for buyout folks, where like you have visibility after 4, 5, 6 years. If you're early stage investor venture and would like to see some results after 4 or 5 years, like the best you can get is some up rounds, who are the co-investors, of course, also runway, and when they raise the last round, evaluation of that, and all those kind of things, which are a bit more sophisticated. But otherwise, the visibility, the DPI, also the dynamics, like we can definitely feel that ourselves as an organization, how we have grown the last, like since 2019, with regards to like cross-fund investments. How are they working? In buyout, maybe people will think, it can be very complex, at least when you're doing cross-fund investment in buyout, with regards to you getting some carry or some exit realization and stuff like that. But in venture, it can actually be a double down on an investment that you think very highly of, and usually do not really lead the round, evaluation. So many things that venture folks are feeling that is so natural doesn't come natural from the thinking when you're a buyout fund or buyout focused LP, for instance. So therefore, I think that's a key takeaway when you speak to people which are trying to tip their toes into venture. And I think, and maybe you can also allude to that, Joe, like who is the one who have actually been hit with a trust or the interest in venture? Because I think is the ones who have either invested in the late stage VCs in the peak market, or who have actually started out a few years before with early stage focused managers, and then their portfolio have been reset and actually been hit. Because I think our timing have been perfect, just to sum that up, or in my note there, because we started out in 2019, but like our first 3 years, what we have invested in there, only like 1/3 to 40% of that is actually called right now, right? Because that's initial in tickets and then follow-on investment. So for us, it's not because we tried to time the market. We can talk about that because we had another view on that, focus on early stage and not late stage. So much inflow of capital, we were a bit reluctant to do that. But our timing in that sense is just perfect, where I think people who have been just like 3 or 4 years before that can now see the results that they were looking for have really been reset or 1 or 2 turns down.
Joe, I want to call on you because you were about to say something before, and Christian threw your bone. So please take it.
Well, there's a lot of good stuff there. So I was wanting to jump in about 6 times already when Daniel and Christian are going. I guess maybe I'll not repeat, but part of your question, Andres, is about LP management. So, LPs are investing their money with managers because that manager has a specialist expertise. They're basically hiring that team to manage money for them. And my experience of LPs is you could divide them into 2 types. One is the type that really wants to understand, and through the managers they work with, through us, learn. And so, we think our job is to help them. Whatever they're trying to do, they're trying to understand and learn the market. They're trying to do more in the market, more investments. They're trying to co-invest. Whatever they're trying to do, I think part of my job is to help them. So we just think spending time together when they want it is important, and we make time for that. That's not every manager. Some managers give me the money, leave me alone. We kind of take the opposite position, which is, if we're fanatics about this market, we love it. It's a passion for us. And if you're excited about it too, that's quite easy to spend time together, even down to, well, don't take my word for it. Let's go talk to a CEO of a startup and understand the problems and challenges they're having. Let's talk to some VCs and so on. Then there's another type of LP, which is basically saying, hey, I don't have time. This is like a little part of what I do. Dear manager, please take my money and do a good job, and I'm going to check in with you, in paper 4 times a year and probably in person once a year. And that's okay too. I think, fair enough, so long as we can have a a sensible conversation about the puts and takes. I think, what you guys are saying, I totally agree with. Most financial assets they would be investing in have commonalities with venture. The couple of weird things about venture, most assets have a single finance moment. In buyout, you buy the company, right? You're done. You own it. You do what you're going to do with it. And there may be, debt packages and whatever, but in venture, you're financing the same company again and again and again over time, with different risk reward profile, with different amounts of capital, with different investors coming in. It's not one group, it's a syndicate. And I think if you're totally new to venture, that's kind of weird. Where else does that happen?
Yeah, very interesting. Daniel?
I think it's interesting, when we discuss the total space of venture is, again, is
Feel
so
free
diverse
to go,
and sorry?
Yes, please go.
Yeah, good. Thank you. Now, I think that when we discuss the venture space is so diverse as well. So we have seen over time that various subsectors of venture capital were outperforming, but you never know which one. So for instance, at some point, biotech is performing super well. Actually, biotech is the one that is super interesting. It's probably the most high risk. But if you look at Cambridge Associates data, it's actually over time is by far the best IRR over time. But then there are some other sectors where everyone is saying, well, it's so hard to do them, like let's say deep tech or materials. And most of the time you see very conflicting on return years, they are completely shooting through the roof. So doing venture from whatever country and whatever perspective, I think people are doing this very much for diversification purpose and for just probably exploring or believing in something like, let's say, clean tech or deep tech, like trying to bring the world somewhere further. So I think it's a good conversation to have all the time. So we, for instance, right now in Latin America, a lot of capital is sitting and it's very hard to implement this capital locally. So many are looking for alternatives, and they saw suddenly that some of their local companies financed by the US VCs are shooting through the roof, and they're suddenly, wow, VC is very, very interesting. And they're starting to look at opportunities in Europe. So I think these are the conversations that actually spark the opportunity and also spark interest, which we try to build on. But it's true that it's very hard to have this very generic conversation. It's always an opportunity that drives investment in venture capital.
I mean, there were two both Katrina and Joe. The key word I think was conversation. Before like speaking with an LP, prospective LP, eventually considering committing to your fund, make sure he, them, they properly understand the nature of private markets. This is not how public equity markets work, where I can, by a push of a button, buy and sell. And the target that I buy has no say in this decision. Every deal is a result of a negotiation. It's hard to get in and even harder to get out. And private markets are private by nature. There is no information available other than you surface that information. In public market, you read the newspapers and you get an idea how Microsoft is doing. You will not get this when investing in emerging tech company aiming to disrupt Microsoft. And before trying to convince someone to invest into venture, make sure they understand how private markets work and how much money in the recent decades has flown into the private markets. And this is not only due to the central bank money supply over the past 15 years. That's a even longer term trend. Companies stay private for longer. Just look at Stripe. They called off the IPO, the so much expected IPO again. They stay private for longer now, with an average a period from foundation to liquidity event 13 years, average, not longest. If a company does well on the venture path, they raise a round every 2 years. 13 years, that makes 7 rounds, A, B, C, D, E, F, G. That and to wait for that in liquidity event. Liquidity is not only IPO. There is such a small fraction of companies that actually make it through IPO. But I think the whole ecosystem has to work together to allow liquidity on the way up, and not only be understood as negative signaling if a very early stage investor has the appetite to liquidate the position, say after 4, 5, 6, 7 years in, and that company is only halfway up. That should be much more understood as an opportunity for growth funds to take over.
Daniel, can I just ask, sorry, Andreas is going to just jump on that there. So can I ask the group, while we're on this topic, what the group's opinion is on secondaries in Europe and the space for that now, considering where we're at in this unique time? Because at Flow, we're getting funds coming to us every single day, either looking at doing a dedicated secondary fund or looking for unique ways to provide liquidity into your existing portfolio. I'd say it's a daily event. So I'd love to get the opinion of the group overall here and on the topic.
I was about to say that even though this was not the topic of the conversation, neither exit strategies during deployment or during your fund, nor secondaries, but I do think that it's a topic that is so closely linked to managing LP happiness. So let's maybe kick it over to you, Joe, for you to start us off on secondaries and also reflections on realization strategies.
Well, I'm with you, Tom. Secondaries have taken off. Literally January 2nd, I got a deal, and we get a deal or 2 every day now. And we closed 2 last week. So we're a buyer of secondaries. And, so as a buyer, I'm super excited about it because, as you know, as we all know, we have the biggest stock of venture assets in Europe ever, in the history of Europe. Hundreds and thousands of companies, right, and funds and so on. However, in most capital markets, you have liquidity tools. In this one, you don't. So I do think that's a big growth area. Not only do people want to exit, but also there's a nice opportunity to buy in. Actually, you highlighted one, Daniel, which is isn't it a nice thing if early stage investors could exit at some point and late stage could pick up? They start the clock anew. They have a different risk reward profile. So, and here in Europe, we're a little behind on the evolution of that segment of the market. So in the US, you've got a bunch of good secondary funds have been operating for a very long time. Then they do it very well. And so there's a kind of liquidity tool there, if you will. In Europe, we have great private equity secondary funds. I used to work for one. They're great, and they do what they do, but they don't operate in venture. For all the reasons we hinted at earlier, it's a different animal. However, we do, a few others do, and I think more will come.
I think actually from a pure manager's perspective, it's probably the most exciting time to be in venture in Europe. I'm on the fund side now for 13 years. I've been on the entrepreneur and tech side for another 13 years, so that makes 25 years. I've never been as exciting as now. Europe is at a point where we can really make this ecosystem work. If we manage to get secondary liquidity in, or tertiary even, or even later. So if we make that ecosystem really recycle, and without recycling, it's not an ecosystem. It's not sustainable. It's not an ecosystem per se. So this now is the big difference to the late 90s and into 2000, when we were not able to do this. The whole ecosystem dried out and broke together. And now we are actually, regardless of market environment, inflation, yes, no, interest rates, yes, no, that's also not so important. The liquidity is there. We only need to allow it enter the system at those stages where we all would need it. And so, Tom, to your question, I think it clearly 2023/4 is the year of the secondary. they have been here before, but nobody really spoke about them. That was, you know, the dirty boy of the industry. You don't lay off your companies, you ride the wave to the end. Oops, the end came quicker than we all thought. Shouldn't have been better sold. And over here we are putting active work in this, and that's you know, be prepared when the opportunity arises. And for many outsiders, this then looks like luck. It's not.
But Daniel, if I can pick up on your point, it's a systematic effect, right? In other words, if liquidity is present, then to a little bit like labor markets, where you have protectionist labor markets, it's difficult to hire, it's difficult to fire. Where you have fluid labor markets, then talent moves, and it's easier to hire, easier to fire. And I think that same principle operates. When LPs know there's an option, they may never use that option, but when they know there's an option, then they could rebalance, and they're more likely to do primary and be more comfortable with primary. The same with founders. When we buy founder shares, we often talk to them about what they're doing with the money. And there's two answers. There's a range of it, but they all fall, well, I don't know, 80-90% are, I'm buying the house that I couldn't afford before, and I'm doing startup investing, which is amazing. I mean, so we've just done one recently, and it's a founder who's built a very large, successful company, and every year he sells a little bit, and he does angel deals. And I think, how cool, you know, so that liquidity is being immediately pumped back in. We need to close by the end of next week because I have 3 angel things I'm doing, you know. It's how cool, you know, that's not a theoretical talk, that's really how it's functioning.
Yeah, and then I think actually on maybe the last point there is a very overlooked dynamic on the sense that the portfolio companies, when VCs are then trying to find liquidity, previously it had been a bad signal, as you also mentioned, Daniel, and still is. But maybe this can also change in the current environment where the startups are actually getting profitable early on and get to break even, where additional capital for the runway extension is less prominent and people are more willing to actually have that ownership transition rather than just a financing event or a funding event right now, which have been the very much in the essence of what you would otherwise have as fundraise, right?
I think
benefits the whole ecosystem, right? Because if we create DPI now to the LPs, that could be AUM tomorrow.
Yeah.
Katja, you were about to come.
Yeah, no, I just think that from the manager, like GP perspective, liquidity is topic number 1. This is first thing to say, so we are thinking every day about it. But it's also a complex topic because it's always a balance between maximizing the value to our LPs and actually providing value as soon as possible. And this is not always going hand in hand. Most often it's conflicting. And then there is coming situations like today where it's globally a more difficult market, but in Europe it's kind of like it's completely, it feels like it's really collapsing in a way, liquidity market. So basically we have to think very carefully like what is the best, and we're asking proactively our LPs like what do you want to do with our assets, and actually the answer is not very straightforward. We hear different answers. We hear sometimes, look, keep as long as you want and sell at the highest value when you can, even if it's in 3 years, 4 years, we don't care. And some say, well, provide the DPI as soon as possible. So in this situation, it's actually like even providing to our LP base, like to provide the best value, we have to balance a lot of things. And to be honest, today the companies that are performing well, the question is like, do you really want to exit in this environment, or you want to hold and find the better opportunity, even especially if it's an IPO candidate, right? So it's just like a question also to everyone here, like what would you do? But at the same time, of course, when there is like when you see that the companies, for example, they are growing, but it's not anymore as kind of long-term opportunity to hold for a long time, maybe there is a great opportunity to have it as a secondary transaction. So it would be interesting to hear also opinions around the table, like how do you see this kind of timing versus the DPI?
Yeah, I think that is the key question. Money now versus money then. I have probably a controversial thought in my head. Now, as we're operating in an environment of elevated interest rates, couldn't that actually be beneficial for creating DPI now? Because the time value of money in an environment of elevated interest rates is far smaller than it used to be 2 years ago. When interest rate was zero, the future infinite future profit was present value. Now it's not. And that might even bring large asset allocators to the point that they might favor an earlier liquidity than a liquidity event in the far distant future. And if that is the case, I think that could get the whole recycling of allocated capital freed up, be recycled back in. Going in a dimension we have not seen yet.
But I think it's also back to the case that is power law returns, especially for the early stage managers, right? So therefore, it's a few key decisions that you could have made in the last few years, which would either be a death or something that you could really thrive on, right? What we at least try to ask people are like, okay, so what are your practice? What are your thoughts around it? And we think, especially for early stage managers, is way more art than science, but at least discipline in place and then take it case by case. That's what we really like, because then you actually have something that we can look back on also as an LP, making our work way easier when we're talking like 3 or 5 years time, when the waves or the sentiment have maybe changed over time, and say, okay, what could we have done differently, right? And yes, of course, getting some DPI is great for some LPs especially. However, what we really like is also DPI in the end of it, right? So you can definitely come in a case where I think some VCs can be too focused on getting DPI, but yeah, that has not been the case for many people, at least in like the last 3-4 years or in the peak time. But if you had, for instance, a blockchain, right, where people have been able, because there were a market for it, to actually distribute quite much over time. And I think those managers are, at least what we see here, and also what we give a huge, or we definitely appreciate, is the ones that have had those talk over time. They can see the asset have been increasing very, very fast and promptly, but they have also been disciplined enough to actually take a bit out of this position over time as it have been up. Yeah, crypto is back in the game, but I think those kind of conversations are very mature, and that's what at least we as an LP really like to have.
Joe, I'd love to ask you to come in on this, both because I remember you saying interesting things also during the up market, and then of course because you have such a large base of European VCs that you are of course trying to guide, or at least provide perspectives to on this exact topic.
Yeah, I think what Katja started and Daniel was commenting on as well is all investors have different time value of money. And that's what, as we get a market cycle, all of a sudden that becomes relevant. When we're all in the low interest rate environment and time is infinite and, money's cheap, we kind of all acted roughly the same way. But when things change, that time value of money concept really comes out. So on the extreme end, if you're a pension fund and you have liabilities 20 years from now, well, you should hold and maximize multiple, because multiple, we all have to remember, you can't eat IRR. Multiple is what pays people in retirement to have a great life. So, but on the other end of the spectrum, if you're, a high net worth or a family office or something, you may have other things to do with that money. And therefore the trade, you could redeploy in other projects. You could start your new real estate project by taking some money out of your venture book, as we now know Daniel's doing. So I think we're in that moment now where everyone's kind of considering their time value of money equation. And what we're telling our VCs is very case by case. So it comes down to how mature is the company. And again, what Katja said, which is selling now may be possible, but it may really undervalue your star assets and ultimately be bad. So I'll tell you what we've been doing a lot of lately is offering liquidity to the LPs of a fund. So working with a GP to say, hey, we'll make a price for your fund that we'd be willing to pay now. And any LP who'd like a partial or full liquidity, well, we'll buy their piece. And so that seems to work really well. We're doing it a lot lately because it's a nice thing a GP can do for their LPs and say, hey, here's an option for you. It's not benefiting the GP directly. They're not taking in capital. It's just LP to LP sale. But I think that's something which I've done it for our LPs in the past, where I'm really helping and say, okay, I understand you have a need or an interest in or whatever, and you can also get pricing at different points in time. So maybe you don't like the pricing in Q1, but maybe by Q3 things have changed in price. So that is happening a lot more now. I don't think that helps you. So that helps your LP. And by the way, we were just doing one now where it's basically, please buy Fund 1 because I want the same LP to put money in Fund 4. So that, recycling works on the LP level as well as the founder level. Nonetheless, the exit market has slowed down and we're not going to change that. So fundamentally, I think growth investors buying early stage investors is a good thing, but you come back to at what price? And most of what I see now is rounds that companies need to raise. They've tried not to raise for as long as possible. Now they need to raise, and they're being, depending on how urgent that need is, see a lot of not very nice deals, kind of some predatory deals. I don't know. I'm be interested what others see, but I've seen some real predatory deals lately where we know you need the money and we're going to cram down all prior investors and we're going to do this. I don't know. I don't like it, but it seems to be a feature, at least right now.
Now, I know we could go on for hours and hours on this. I think Daniel, you called it before 2024 being the year of the secondaries. I think we could also call it the year of conversations about how to generate DPI. And for that reason, of course, we're doing a side event at Superventure just about that. So let me know if you want to join for a full conversation about that, because I do think that this is what's on everyone's mind. But in both in the interest of time, we can get 90 minutes pass by very, very quickly, apparently. But also as a token of respect to those who came just to hear about fundraising, let's get back on that topic. And I want to just show a graph here where I am, or a pie chart or whatever we should call it, a wheel chart, where we have put together the answers that we have received from our 300 episodes that we've done on the podcast, where we've asked our VC guests, what would be the key advice you would give to emerging managers fundraising across Europe? And then we've taken that and broken every single piece of advice, thank you AI for helping us there, into some different categories. And we've got network and relationships being the really big one with 28.6%, so almost a third of the advice was really about the importance of building and maintaining strong professional relationships with LPs. And we're going to dive into each of these, but I just want to summarize for those not looking at the chart or for whom this might be slightly small. We have as the second one, the runner-up, 20% or 19.7, saying differentiation and unique value proposition. So this is the age-old advice of knowing your edge, having something special that you bring to the market, being additive, not just being another B2B enterprise SaaS fund. I did not say that. The third one was consistency and commitment. So that's basically grit. It's with 19%, so very close to the one I just mentioned. And then we have a drop off down to knowledge and expertise, which has 14%. So that's about knowing and really showing that you have an expertise within both venture capital as an industry or asset class, and you know how to be a good money manager, but also expertise within your specific vertical or technology. Then we've got transparency and honesty coming in with 11%. I think that one is particularly interesting because it's so concrete, in the sense that all the other things are things that you would kind of imagine or expect, but this is a trait of your communication style and how you conduct yourself, which is a bit different from the other ones that are more skill and things you should do. And then the final one is adaptability and flexibility, coming in with 7.6%, and that is of course also probably connected to the fact that we've conducted, I think, 200 of these episodes, these interviews. We've done them during the tech reset, so a lot of people have had to navigate a bit during that period. Let me first ask the panel here for a quick remark on the split here. Does it cause you to have any reflections at all, or do you just think yeah, that matches pretty much what I'd say?
Good question. Good question. I do see a bit of a, I wouldn't name all those 6 or 7, is it, myself, but may add 2 or 3 more. But I do see a bit of a contradiction between the second large one saying expertise and specialization versus the third or fourth in line, say the green one on the bottom there, saying knowledge and expertise. Isn't that to a good part very closely related, these two?
Yeah, they are.
And if so, those
I can tell you what's behind
there's a third one missing, and that would be long-term perspective and discipline.
Yes, absolutely. So we have actually discipline, we have with consistency and commitment. Long-term perspective definitely might also go in with that. We could have bundled it in together with that as well, and it likely is as well, actually, because it's that you're in this for the long term. You're not venture is not. We have a bunch, and you'll see that as well in the videos that I'll play in just a second. A lot saying that venture is not a short-term game. You're not going to get wealthy tomorrow. You need to stick through it, and it's a long uphill battle. As to the overlap or difference between differentiation and unique value proposition and knowledge and expertise, if I should just add one comment there, it's the red one is purely, this is about you having an edge and showcasing that edge and showing that you're meaningful in the market with that edge, and the other one is being broader expertise across. But I get what you say, Daniel, and this type of thing you can always debate how you break it up. Let me go to the first video that I wanted to show you, and now Andreas is getting techie, so bear with me if I'm not very successful here.
Warm introductions, sadly, probably our biggest source of conversion. So always try and seek a kind of first or second degree connection to a target.
Don't be too demanding when it comes to ticket size, because I think especially as an emerging manager, it's also a lot about relationship building and trust and familiarity and building this network. And then, try to get a piece, of course, that add value. And most importantly, and this is what I said earlier already, if a family office or a multi-family office does not give you a commitment in the first fund, keep them posted over the next 2-3 years. Give them 2 update calls a year. You do so much of the work then already. And fundraising is something that goes on forever. It's not something you take a big break from. And I think this is the thing that is most important, that emerging VCs do not forget their potential piece that did not invest yet.
So That was Daniel Schex and also Ms. Steele from Ascension. I would love to ask you to both comment on what they said, but also give me your key advice within the category of network and relationships. Daniel, we already have you highlighted here, and we just have had Mr. Schex say, you should not treat fundraising as something that you stop in between. That is synonymous with the Speedinvest approach, I'd have to say.
True. Fundraising never stops. So I think that approach from, like, also like we did it in our early years, like, go out every second, third year on a campaign. I think these times are over. The market is far too big. There's far too, also in terms of competition of other funds, and also never forget the competition of the other asset classes. And that's the main competitor, actually. It's not about a fund A or B. It's venture. First of all, venture at all, yes or no. And the second degree question is which fund to pick. So we say always be fundraising, ABF. And the best time to fundraise is actually just after you have successfully closed the fund. For multiple reasons, you have shown to the market that you are a product in demand. You currently have nothing to sell, so the LP is not in danger of being pitched. Everybody wants to talk to you. So actually, you should travel just as much in the weeks and quarters after the close as you do before.
You have shared with us on the podcast before that you always put in a lot of travels right after the fund close, one of them being to the Middle East region, where you have a considerable number of investments and LPs.
Yes, true. And also what Emma said in the beginning, obviously the referral or the warm introduction is best, but I would differentiate a bit. So it's great to get a referral from an LP, but the pinnacle is a referral from a fellow GP. So if a GP tells an LP, talk to these guys, this is it. So I think it's just as important to work the LP market is to create a community, an environment of a friendly network of fellow GPs who you frequently co-invest with, early stages, later stages, same stages, like-minded people. Helps you a lot to understand the industry from an additional perspective. And if a GP recommends a GP, I don't know, Christian, I don't know, and Joe, what do you think? But I think this is it.
Yeah, and I think it's very much coming back to the point that LP is also different, right? So you need to consider always who are you talking to. And you can actually take the pie chart you also just showed, Andreas, and you can probably just divide it into two, right? You can say specs which are alluding to how attractive or good an VC you are. You can have some figures, of course, with performance. You have an arbitrary opportunity or whatsoever, right? A flywheel going on, whatever it could be. And then you can also take the other side of it, which is how well are you in articulating that? And not just articulating and communicating how you actually with the LP in mind that you're speaking with. And you can tailor that both with regard to the approach, but also what you talk about and how you talk about it. And I think it shows, at least from where I sit, it shows a lot about how venture managers are when they get where I'm from. So if they're asking me, what's your annual budget? Like, I don't have an annual budget. I said that in my introduction, which I actually are very intentionally about, like, trying to say out loud how we are thinking about the market and the place, right? Because then they can get that context, and hopefully we can dive into a conversation which is tailored for who we are right now in the dialogue, right? So rather than having those kind of discussions, which are not like, they should have a thought around like why or how am I actually fitting in, or am I not fitting into their portfolio? So if you came to us in 2020, where we just started out and we were not looking for late stage exposure, and that's what your fund were. Like, yes, we look into that and have many discussions with our financial sponsor about whether now is a better timing for us to be serious about that and dive into it. We have made some follow-on and opportunity funds, whatever you like to call it. But that shows me a lot. So yes, it's about, of course, trying to be as good as possible and also convey that. But I think that says a lot about a manager, just as when the VC VCs themselves are also speaking with deal flow, right? Like the companies, are the entrepreneurs, do they actually understand where the VCs are investing, what they look for, and how to present themselves? And not just, of course, it's also amazing when entrepreneurs are just heads down and doing really, really good work on the startup itself. But of course, it works to have a blend of that. And I think those comments that we just saw from Emma and Shai there, like warm introductions are good because they're usually from people that you, for instance, me as an LP, think highly of. So domain experts are an amazing tool to also underwrite or at least get related to other people in the business and industry. And of course, keep posted, because otherwise I feel like this is just a selling exercise for you. And maybe that works for some people that they happen to have an annual budget with your mandate. But I don't think both Katarina and also Daniel, the ones that you love the most of your LPs, aren't probably those kind of people. That's like an opportunity that you can be lucky enough to hit at the right timing when they are around or whatsoever. But having those ongoingly, I think is really important. And sometimes I can feel it myself that, oh, now we have had 1 or 2 meetings, all the basic information and Nate made notes about it and stuff like that. And now we're getting to the interest part, because now we can really talk about the co-investors who if I'm a good LP, which I like to think about, like really trying to be sophisticated, I've also diligenced you over the time. So rather than having like a snapshot on you right now, when just like 1 month before your fundraise, movie clip of how you are as a person, how you react with or interact with LPs, but also how you're actually navigating such as last 4 years, right? Because it says a lot to me. So I figured out like over the years, like some people maybe not this time around, but next time, yes, the timing could be much better.
Now let me take us to the next one, because
I think we missed one word from the.
Go ahead, Katja.
Now, just a quick comment on the word that we missed from the video. It was sadly, the highest conversion from the warm introduction, which is nothing surprising, but it's interesting that this word was there. So I think it talks also a little bit about the, how things move in the networking circles, and we see also in the venture capital investment the same thing. So it would be good to think about actually how to navigate these kind of circles as well, because people know each other from universities and so on, and sometimes there is lack of welcoming for people who come from other backgrounds. So this is what we observe. It's just a comment on this. Like I picked up on this word sadly in the video, but otherwise it's kind of everything makes sense.
You're absolutely right. That word was in there. Joe, you're about to say something.
Yeah, can I argue? I do it with fear in my heart to this very smart, experienced crowd, but can I argue a point, which is we all like the warm intro. GP to GP is the most powerful, of course. However, I wonder if you actually look at getting the meeting versus getting the investment. Something Christian was hinting at, half of the decision to make an investment in a fund, the buy decision, half of it is what the fund is doing and the quality of the proposition, but an equal half of it is what the LP is buying. So to me, the warm intro is simply getting your foot in the door. It's opening the conversation. But I really wonder if you could do an analysis on what's actually closed, if that would be a high probability. And I'll give you, real examples from our world. We meet people where we have a great connection. We really see the market in a similar way. We can help them. But, something you said, now's not the moment. We're not yet allocating to VC. So wonderful, warm, I love you like a brother conversation. But then the reverse has also been true. We've just met some groups. One of our favorite big institutions from the US that invest with us. And we think we're rock stars, but actually I think they were looking for what we do at exactly the moment we met. And it wasn't that we were somehow amazing salesmen. I don't think we are. It's just that they were kind of searching and hunting. How do I access Europe? We offered a solution. It worked. It wasn't a warm intro. It was a random event at the buffet. Like, can I get one more of those chicken fingers?
But I think that's a perfect analogy. And also, like Hampus Jacobson from PayPal have also been on your podcast, Andreas, right? And also talking about how it's almost as dating, and that's also what you're mentioning now here, right, Joe? It's not like a one night stand, and it's a marriage, right? And I have 20 funds, and I will make commitments to over the next 3 years. I'm not just gonna make a spray and pray or whatsoever just because I got a warm intro, but yes, because my interest is spiked because I have one who have a high conviction and who actually said nice things about it, right? So therefore, I think folks would be really considerate about that and not be too pushy, actually. Even though some funds can be desperate to get some capital, being human and balanced and is really beneficial, especially over time. I only think you can underestimate how the industry is like that. Especially also just focus on the pie chart that you just showed, Andrea, right? Like this is also a networking game. People know each other, and what people think about you over time, it also says a lot about you. So I think LP, even though GPs and to GPs warm intro are great, then LPs also talking together, right? So if you're burning your current relationships or are way too aggressive or hyping up your fundraise or whatsoever, then I need to discount what you're saying to me way more than what I actually like, right? So being transparent and being warm, really being conscious about people are speaking together and not trying to hype it up as it was in 2021, where even the fundraise from the funds were really, really quick, right? We are also having more time, very fortunate, to do our due diligence. And when I'm digging in as an institutional LP, it's a huge, let's say, bet from my side too. I have those 20 investments that I'll make over that next 3 years, and I have a core book right now. I take re-ups very serious. So therefore, I have an investment memo I should make. I should present it for an IC and all those kind of things. This is just not something we just do by left hand or something like that. So yes, it needs how you really build that trust and also that interest and conviction to go forward in relationship.
Now, I really do want to show off my tech skills and show videos. So please, guys, let me do that. We will go to the next one, which is differentiation and unique value proposition. And I'll pick Joe to be the first one to comment on it afterwards, because I know you have a good perspective on presenting your fund as a product. But let's first watch this small video.
Don't compromise on what you think makes you unique. LPs might be tempted to shape you to what they know, but don't let that be the case.
Please do not be generic. LPs are overwhelmed. They hear pitches all the time. For example, there are too many funds whose investment thesis is limited to underrepresented founders. It's unlikely to carry you because it's not enough in itself, right? So whatever angle you take, please don't be generic. I think today you have to find what you're uniquely good at and ways to stand out and force yourself to hone that value proposition until it feels quite differentiated. This is not an exercise in filling the slide deck. It's like understanding exactly what you're best at and demonstrating it.
People need to understand what their own wheelhouse is. I often talk about like ventures, like you're kind of mining gold veins, and once you find that gold vein, whether that's a particular kind of insight you have on a market or a smart like a network that you have, double down on it. Double down on your own weirdness. Double down on your own experience set. Run against the crowd. Be contrarian, and sort of don't look over your shoulder too much. I think we as an industry do that too much, and that's the advice I'd give any emerging investors.
So those were the videos. Joe, will you give me a quick comment and then we go on to the next one? Because I do want to cover the first three big ones on this before we run out of time.
Yeah, so my quick comment is your fund is a product like any other product in your portfolio you're advising. It has features, it has benefits, and any LP that's met lots of funds has a wide choice of products. So why is yours better? So there's a BMW, there's a Mercedes, there's a Volvo, they all have features, they all have something different, and you need to highlight those aspects. I think what they're commenting on is your strategy. Going after a certain type of company, a certain type of founder, or whatever, do something that you have a superpower in. But then when you're explaining it to the LP, you've got to make that clear. We're doing this, but also the second part, which is because it has value. We're not just pursuing this type of company because we like that type of company, because we think they can be big and important tech companies and whatever. So you have to have both, right? We're doing something others are not, therefore we're a good add to your portfolio. And we're doing that something because it has high potential value.
Beautiful. Now let me put on the next one, which is on consistency and commitment. So this is all about showing grit.
When Harry Stebbings and I started Stride, we were getting no money, and people thought the team was weird with the young guy and the older guy, and it was actually more difficult than people might realize. And at some point, we put ourselves in this kind of mindset of deciding not to fail. It doesn't mean you're not going to fail, but it was like a mindset of, hey, we're just going to make this work. It's going to take however long, we're going to need however many leads. But it was probably the most helpful thing that we did was to really go there and kind of own that success mindset. And again, it doesn't mean you're going to make it, but at least it's a great prerequisite.
Well, the main and the most important tip is to stick to it. Don't give up. Just do your work whenever possible. Be creative. Also, try to think of potentially other. Try to find other LPs that other people may not think of. And the main thing is, of course, focus on your track record and try to build that, because that's the key parameter that LPs will look at along the way.
So Grit, anyone who wants to take us out with a comment around how tough it is to be in VC, and we can all close this sobbing?
Yeah, I think, launching and running a fund is an entrepreneurial effort, just as any of the founders in your portfolio. I've done both. It's practically the same, it's just a different business model. And obviously, all that, Carlos, Colin, Fred said there, all is true, no question. These guys know what they do. For no reason they are considered to be among the best. Don't be generic. That's probably what it gets down to. But then you have to put everything else in, right? Be consistent in what you do, in not being generic. Find your niche, build out the expertise, generate that proprietary superior deal flow, select well, often enough. We all know that 8 of 10 go under that we pick, and stick with it. If you're trying to be generic and opportunistic, that inevitably you end up trying to time and trail the market, and that does not work. That does not work.
If I may, yes, I think it's true in venture capital more than in anywhere else. We cannot control the outcome, but we can control the process. So we don't really know what happens in the market, but we know, actually all of us know intrinsically what would be the right thing to do and how to. So if we build this very high probabilities that we will hit more the right things than the wrong things. And I think this is what we need to try to continue to build up. Because like in healthcare and everywhere, we cannot really control all the outcomes, unfortunately.
Katja, thank you so much for not leaving us on a depressing, sobbing note, but rather say that as long as we stick with it, we will be successful. Now, before I close and pass the word on to Tom, I just want to let you all know that, of course, you can go to flow.io/raise to sign up for the report. You'll get it in your inbox as soon as it comes out. We're also putting out quite a few episodes on the podcast specific to this topic, all of them talking about how, as an example, Daniel and his team at Speedinvest managed to raise their fund, their latest fund during the tech reset. We also have HV Capital's Rainer Makel on, where we talk about their latest massive fundraise and a ton more. So definitely this is going to be an exciting coming month. Tom, please take us out of this space.
Cool. So thanks to all of our guests today. It's been really, really wonderful conversation. I think lots of insight, and we could probably talk for hours about this. But as Andreas already said, for more information on how Flow is partnering with VCs on all of the topics we spoke about today, whether it be raising or administering your fund or running your fundraise or or technology and solutions for the VC space, just go to flow.io and my team will be happy to help you guys out. So thanks very much.
Beautiful.
Tear down this wall. It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.
In a landscape reshaped by text reset, inspiration calls to me. Guiding steps in venture's quest, in wisdom we proceed. As markets shift and paths diverge, a vision clear I see. With wisdom's voice, the path we forge, in prudence we're free. Proceed. With insights deep, our course we lead. And when the venture's heart seems torn, in unity we find a beacon bright, emerging dawn in wisdom intertwined. Though paths may part and challenges loom, in collaboration we believe. A shared vision in the room, in wisdom we conceive. Proceed. In unity our fears recede. Proceed. In unity our fears recede. Proceed. With insights through thee. Guiding star remains, illuminating paths so bright to clarity we regain. Awakened by the dawn's first light, inspiration's gentle beat guides us through the investment fight. In wisdom let us be, and let us be. In wisdom's voice, our ventures free.
Day and night, tirelessly I strive to settle dues that life demands. Oh, how it stings. Yet when the day's toll is paid, not a dime to my name stands. Such bitter things in dreams of vision so grand. A life of leisure, hand in hand, with fortune vast at my command. Enjoy and jest across the land. Funds would be so lush. In a world of wealth, a rush. Funds, always a gleam. In a world of wealth, a dream. Ah, the splendor I could weave, with just a bit of gold to sleeve. It's a world where wealth sings. It's a world where wealth sings. Finding him is like a maze, but he's ever in my gaze. Oh, how it stings. Should he be free, might he glance my way, or would I just be in a daze? So off I dream to distant shores, where luck and fate might open doors. A twist of fortune, and who knows, my life might just hit new highs and lows. Funds would be so lush. In a world of wealth, a rush. Funds, always a gleam. In a world of wealth, a dream. Ah, the splendor I could weave, with just a bit of gold to sleeve. It's a world where wealth sings.
The shadow of tax grand reset, a quest to raise a fund began. A journey fraught with sweat and toil, yet forward we did run. As markets quaked and trusted way, a clearer path we sought. With wisdom as our guiding light, a battle fiercely fought. Forge ahead through the storm we tread. With every pitch our vision spread. When hope seemed dim and hearts grew weary, in unity a flame did spark, a promise of a dawn yet cheery. Through